Introduction. The accurate measurement of business performance hinges on two fundamental elements: revenue and expenses. These are the primary components of the income statement, also known as the profit and loss statement. Central to understanding how revenue and expenses are recognized is the matching principle, one of the core accounting principles under accrual-based accounting systems like IFRS and GAAP. This module provides an in-depth exploration of how businesses record income and expenditures, the rules that guide recognition, and how these practices influence profitability and financial reporting. What is revenue? Revenue refers to the inflow of economic benefits during a specific period arising from the ordinary activities of an entity, typically from the sale of goods, rendering of services, or use of company resources by others. Sources of revenue: sales of goods, provision of services, interest income, dividend income, rental income, royalties and licensing. Key terms: gross revenue, total sales before deductions; net revenue, sales after returns, discounts, and allowances. Revenue recognition principles: IFRS 15/GAAP ASC 606. Revenue should only be recognized when there is a contract with a customer, the performance obligation is satisfied, the transaction price is determined, the transaction price is allocated. Revenue is recognized when control of the good or service is transferred. Example: a business sells furniture and delivers it in July. The revenue should be recognized in July, not when payment is received, unless on cash basis. What are expenses? Expenses are the outflows or depletions of assets or incurrence of liabilities from delivering or producing goods, rendering services, or carrying out other activities that constitute the entity's primary operations. Types of expenses: operating expenses, selling, general and administrative, SG&A, rent, salaries, utilities, cost of goods sold, COGS, direct costs of manufacturing or acquiring goods sold, non-operating expenses, interest expense, losses on disposal of assets, depreciation and amortization, tax. Expense recognition. Expenses are recognized in the same period in which the related revenues are recognized. This is the heart of the matching principle. The matching principle. The matching principle states that expenses should be recognized in the same period as the revenues they help generate, regardless of when cash is paid. Examples of matching: salary expense paid in January for services rendered in December should be recorded in December. COGS for a product sold in August should be recorded in August, not when the inventory was bought. Matching ensures that the financial statements show a more accurate representation of profitability and operational efficiency. Accrual versus cash accounting aspect. Accrual accounting, cash accounting, revenue recognition, when earned, when cash is received. Expense recognition, when incurred, when cash is paid. Matching principle used, not applicable accuracy. High for performance analysis. Less accurate note: most large businesses and all publicly listed companies use accrual accounting. Revenue and expense in the income statement. The income statement follows the format: revenue minus COGS equals gross profit minus operating expenses equals operating income minus taxes or interest equals net profit. Example: particulars amount, Naira. Revenue, sales, 5 million, less. Cost of goods sold, 2 million. Gross profit, 3 million less. Operating expenses, 1,200,000. Operating profit, 1,800,000 less. Interest and tax, 300,000. Net profit, 1,500,000. Adjusting entries for revenue and expenses. Adjusting entries are made at the end of an accounting period to reflect revenue earned or expenses incurred that are not yet recorded. Examples: accrued revenues, revenue earned but not yet billed. Accrued expenses, expense incurred but not yet paid. Deferred revenues, cash received before revenue is earned. Prepaid expenses, cash paid before expense is incurred. Adjusting entries ensure that the matching principle and revenue recognition principle are upheld. Posting to the ledger. Once journal entries are made, the next step is posting them to individual T accounts or ledgers, where cumulative balances are maintained. Office supplies. Account. Dr. 50,000 Naira accounts. Payable account. Doctor, this stage ensures that individual account balances are correctly tracked and monitored. Trial balance. The trial balance is a list of all general ledger accounts and their balances at a specific point in time. It's used to check the accuracy of postings and to ensure that the sum of all debits equals the sum of all credits. Example: account debit, Naira. Credit, Naira. Cash, 100,000. Office supplies, 50,000. Accounts, payable, 50,000 capital. 100,000 total, 150,000, 150,000. Adjusting entries. Before financial statements can be prepared, adjusting entries are made to reflect accrued revenues, earned but not received; accrued expenses, incurred but not paid; prepaid expenses, unearned revenues; depreciation. These adjustments ensure accurate matching of revenue and expenses in the correct accounting period. Closing entries. At the end of the accounting period, temporary accounts, revenues, expenses, and drawings must be reset. This is done via closing entries, which transfer these balances to the capital account or retained earnings. Purpose of closing: zero out income statement accounts, update equity balances, prepare for the new period. Common accounting documents: source documents, invoices, receipts, bills. General journal, initial record of all transactions. General ledger, categorized record of all transactions by account. Trial balance, proof that debits equal credits. Financial statements, final output of the accounting cycle. Technology and automation in the cycle. Modern accounting systems, e.g. Sage, QuickBooks, SAP, automate many of the steps in the accounting cycle. This reduces human error, speeds up reporting, provides real-time financial insights. Yet professionals must still understand the logic behind each step for effective oversight and compliance. Common errors and how to detect them. In this course, we will be using error type and description for our table. 1. Transposition error numbers reversed, e.g. 540 instead of 450. 2. Omission error, entire transaction not recorded. 3. Commission error, wrong account used. 4. Compensating error, two mistakes that cancel each other. 5. Principal error, wrong classification, e.g. capital expense as revenue expense. Use of trial balances and reconciliations help uncover these issues. Summary. Module 2 introduces the backbone of accounting practice, the double entry system and the accounting cycle. A deep understanding of this system ensures the accurate recording and reporting of business transactions. This knowledge is essential for preparing credible financial reports, which in turn inform strategic decisions and maintain regulatory compliance.